Welcome everyone to the Real Geek podcast, where we discuss the financial state of the world by providing insight and data. I'm your host, Johnny Garcia, founder and president of the Real Geek Incorporated, which has been helping clients with all their real estate and mortgage needs since 2019. We hope our show provides a little clarity about big issues. After all, it's just math and science. Also, don't forget to subscribe and drop us a like. Now, on to the show. Welcome everyone to this week's podcast. Again, we got Ron Davidson and Dr. Yang Hu with me. I'm Johnny Garcia, your host, founder and president of The Real Geek. And this week's topics are kind of a continuation of what we discussed last week, which is the Federal Reserve and the GSEs, or the government-sponsored enterprises. So to get the ball started off, guys, I'm going to talk a little bit about my understanding of what the Federal Reserve is and their goals. And again, I'm sharing the screen from their website. So I'm like, okay, which was kind of cool because I actually was digging around here. I haven't done it in a while. And I found a couple of videos, like 3-minute videos, that they actually do a really good job explaining why they exist and what they do. But I'm going to try to do a poor man's version of what the Fed is. So basically, the Fed is the great equalizer is what I like to call them. I like to look at it as they have this role of trying to maintain economic stability. Now, what does that mean? So that means they're constantly looking at the financial system as a whole, the banks, the consumers, the businesses, and trying to because they have two mandates from Congress, right? Their two mandates are maximize employment and create stable pricing. So those are their two mandates according to their website. That wouldn't be the words I would use, but that's the words that they use. Yep. Well, I liked it. I'm like, okay, so how do you do that though? So what my understanding of it is, I like to look at it like a teeter-totter. So their goal is constantly trying to keep this teeter-totter level, but sometimes when inflation goes up, unemployment goes down, inflation will go up because more people are working, they have more money, they have increased demand, and prices start going up. So to put that in check, they'll try to raise interest rates or the overnight rate, Fed fund rate, which will trickle into the system, eventually bringing increasing the or decreasing or trying to decrease the price of goods, making it more expensive to borrow money, which would then eventually drop inflation. But one of the unintended consequences of that is that it becomes too expensive for businesses to keep a lot of the jobs that they have, so unemployment will tend to go up. So what do you guys think on that explanation?
Yeah, so I'm a big history buff, and I think that you never understand now without understanding how we got here. So I'm going to take you back a little bit. I'll be quick, but it's still fascinating.
Great Depression?
The Civil War.
Oh, even further.
We're going back to 1860s.
Nice.
So the new Republicans come in, right? So, Jefferson and Hamilton had this battle over whether we should move toward capital and industrialization or just farms and self-sufficiency. And, that was a big deal, right? Like it was Jefferson's sitting vice president, Aaron Burr, who killed Hamilton in a duel. Like these were not mere disagreements on a Sunday morning talk show, right?
Yes.
So
anyway, life and death.
Yeah. So by the time Lincoln comes into office, there's like 9,000 different banknotes, and you had exchange rates for every one, and they were quote backed by gold, but of course at different rates with different levels of credibility behind that and all. But here was the real problem that people I don't think get into. Thomas Malthus, late 1700s, he writes about the Malthusian trap, and in a nutshell what he says is progress isn't possible. What happens is if you get more output of wheat, say, people will just eat more, and then given our carnal nature, the good minister Malthus pointed out, we will reproduce at an exponential rate, even though we've just increased wheat or whatever at a arithmetic rate, and so it'll lead to another collapse. So there's two fascinating things about this. This was pretty much true from the time of the ancient Greeks till then. Suddenly, it changed. Right about the time he writes it, it's about the time Adam Smith writes his Wealth of Nations, and we start to see progress. Why do I mention this? Well, think about the problem. For years, you use gold. For years, that kind of works. Why? Well, for a host of reasons. One is the economy doesn't really grow. It's sort of stable. So you kind of have this, fixed amount with new mining once in a while, bringing a little stimulus boost. But basically, the economy is this fairly stable thing. Well, what happens in the 1800s? Industrial Revolution, the economy's changed and it's growing. The number of people in the US are growing. All of a sudden, it just starts to get harder and harder to manage. What a lot of people don't realize is by 1933, with the Great Depression, obviously that was massive. What a lot of people don't realize is between 1900 and 1933, the US government or the US economy was in recession 47% of the time. The bust was normal. Why do I mention that? Well, from the time of Malthus, where you have a stable economy just because it's stagnant, to the time of the early 1900s, where you have this dynamic economy, it's boom and bust and boom and bust. You're trying to figure out how on earth do we match money to what's going on? And when do we know it's a fake boom? When do we know it's a real boom that we have to increase money for? You really laid it out nicely. The immediate term, short term to understand, was this inflation, is this growth? People can't be sure. And so this adds all kinds of problems. And the one word you use that's so key, system.
Exactly.
All the players in it, they're not responsible for the system. So essentially what the Fed is, and it evolved, it took a long time. But now if you go back to Lincoln and the greenbacks and you have money and it's not necessarily linked to gold, although it did come back to gold standards and all, but basically you're trying to match the growth of money more or less to the growth of the economy. And the growth of the economy is tough to peg. When is it real? When is it fake? When is it boom? When is it bust, right? The Fed emerges over decades, really. And coming out of, the Great Depression, there was even more kind of, Keynes came along with his philosophy, and there was also more pressure to put that in place. Now you have the Fed, and basically you laid it out nicely. The mandate, quite simply in concept, more complex in execution, the mandate is keep inflation low and unemployment low, and then do whatever you need to do with the money supply. Because, if you're just putting too much money out there, well, that'll make inflation go up. If you're not letting enough money to go out there and credit be easy enough, that will slow, right, GDP growth and employment and job growth. So it's a beautiful thing. We have the Fed outside the system, so to speak, tweaking the dials, trying to keep both those things low. And the last thing I'll say is, it's complicated. There's dynamics, there's legs, there's international stuff.
That's what I was saying.
It all gets to be a bigger deal.
Tweaking the dials, and I'm like, it's not two dials, right? It's million. And I think one of the big things that people don't seem to understand, like to your point, from the 1880s to the 1930s, with the Industrial Revolution, I mean, the amount of industries and technology and things that weren't even comprehensible just 15 years earlier just appeared overnight. You had the Robin Barons, right? You had the Morgans, you had the Vanderbilts, you had these guys who were working.
You had running water.
Yeah, they were building their own cities, destroying their own dams, running their kids to the. I mean, there was no child labor law. The reason we have all the restrictions we have today was simply because what these people were doing. And like again, they don't care about the system; they care about me. How can I get my wealth up? And it was literally what was it? There was a great docuseries on History Channel called The Men Who Built America. And my favorite was what was his name?
Carnegie.
Carnegie hired some guy to run his US operations while he took a break in Scotland and goes, I know you'll handle your, whatever the strike is. And he goes and hires people and beats them down. Okay. There was no cops. There was no, as a matter of fact, I believe one of them even shot the guy, the president of Carnegie Steel, and the guy survived and then beat the guy down and goes, no, hell no. I'm like, that entire system, the revolution that was a bubbling, like, I'm surprised there wasn't another revolution in the late 1800s and 1900s.
Yeah, I mean, there were revolutions, right? I mean, fascism, communism, it was, I mean, Keynes really saved capitalism.
Yeah,
right?
Well, and that's exactly right,
Yeah.
Is that the reason communism and socialism and all those other isms became popular was the robber barons had it all and everyone else was just let them eat cake. I'm like, you guys didn't learn from 100 years ago? What's going on here?
Well, so I'll speak in their defense quickly. It wasn't until the early mid 1800s that the word employee came into the English language. you had your kids working your farm, you had indentured servants, which is basically slavery on a contract, 7 years. And then there was slavery until, I mean, it was 1860s, right? We got rid of slavery. And there were a few isolated cases of employees, but really it wasn't until like Ford's massive factory and Carnegie's factory, you started bringing in these guys who were employees. And then what happens is if these capital markets are, rising and falling and, booming and busting, what that does then to employees, particularly now if they're not self-sufficient farmers, it cripples communities and it's devastating to individuals. So the Fed comes in and basically, again, go right back to what's your mandate? Well, try to figure out money markets in a way that keeps the system stable, doesn't result in much inflation or unemployment. So we try to keep both of those down. And, we are going through a period right now where anybody who says we know what's going to happen over the next 6 or 18 months, listen, hear what their arguments are, but have a measure of skepticism.
I think all of us as analysts again can say, anyone that says, hey, what's going to happen in 6 months? And I say, we think. I've never said I know.
I'm talking all over top of Yang, so I'll be quiet for
this. Yeah, go ahead, Yang.
Forward to hear what Yang's got.
So a couple of thoughts. One is that so a couple of things. First of all, I would kind of make an aside is that Thomas Malthus today would point to the construction of freeways as a way of, as instantiating.
Your mic is kind of messed
Can you
up.
hear me? Can you hear me?
Yeah, there you go.
You can hear just a little bit of rumble. You're good volume, but a little background.
So the first thing I would say is that Thomas Malthus today, if he were alive today, would use the construction of freeways to as instantiation of his Malthusian nihilism. In the sense that the more freeway you build doesn't reduce traffic, it just increases traffic to fill up the number of freeway lanes. But I think kind of having a little bit additional historical perspective to kind of what Ron says. Think about, I'm going to use two examples here. One, so you think about, let's think about Carnegie. Think about the economic system of the Great Lakes in 1900. Okay, so think about Detroit. You think about the car manufacturer. You think about Henry Ford in 1900. And the Great Lakes is this integrated economic system, right? You have rubber coming in from Ohio. You have steel coming in from Pittsburgh. You have coal coming in from Pennsylvania. And in this case, you have goods. You have this very extensive trading network of goods, but these goods come in as inputs. Now, I'm going to contrast that to, say, the Mediterranean economic system in, say, during the Middle Ages. And now you have trades, right? You have trades from Egypt to Venice, or silk.
The Egyptians did wheat for the Romans,
right? Silk from the Turks to and so these are you also have likewise fairly extensive trading networks in the Mediterranean. But one crucial difference I would say is that these trades aren't the same magnitude of inputs to other manufacturing things. And so, yeah, wheat and food are important, and if they don't come in, you'll have people will starve. But this is a matter of, okay, well, if wheat isn't coming in from Alexandria, then people in Venice go fish out a little bit more. I don't want to kind of minimize, like, there are starvation, stuff like that, but these aren't input goods the way we think about inputs are. If you don't have coal or steel coming in from Pittsburgh or Pennsylvania, well, you're not making any cars in Detroit. And so in this case, the money use the way of this medium exchange money in the Middle Ages. You can kind of get away with gold, or what they did was they have for example, you have the Maghrebi Jewish merchant system where they have letters of credit. And so you have one side of the family in Egypt that might say, hey, we have relatives in Venice, and this personal connection says, okay, give me a line of credit, I'll bring in, lend me some money, I'll bring in grain from, and you have this system. And you can't do something like that by the time you get to 19th century industrialization, where you need to have these massive industrial scale goods coming to and from between these these are giant steel mills that's hauling tons and tons of steels from on barges on the Great Lakes to Detroit. And in this case, you have to have an evolution of a system that manages the medium of exchange to scale up to these kinds of complexity.
Well, and to that point, and again, I referenced the man who built America. What jumped out at me was the Industrial Revolution didn't just revolutionize industry in the sense that steel and coal and all that, but it was a dynamic shift from agriculture to to warehouse work, right? So literally, most people were trying to find land so they can farm or raise animals or crops. They were self-sustaining or self-producing their income. But once you go to the steel mill or to the warehouse line or to whatever, now these giant corporations, if they go down, all of their workers go down with them. So there's now this incentive for these people to keep continuing to work. I mean, it seemed to me so.
I would say kind of in some ways, this kind of, if you were to draw, if you were to characterize kind of development as this kind of straight line of progress, kind of this kind of line, or in some ways we're trading complexity for robustness. And so we have this international, you think about kind of the international logistics that we have, the system we have.
Yeah, can you raise your mic a little bit?
Can you hear me?
Yeah, it's still muffled, but
we're
fine.
hearing you. It's just, again, it's just a little bit of a rumble, but that's good.
Sorry.
Yeah,
So it's, you think about kind of the complexity we have, and this complexity is what gives you the kind of massive productivity. But this complexity also means that the system that you build is increasingly brittle. And so you have this brittle system, which means you need to have, fail-safe systems and backup systems and regulatory systems, of which the Federal Reserve, like all international central banks, are part of this kind of regulatory system.
Well, it's interesting you should say that. So to that effect, right? The system, it's not that people saw this coming and and put it in as a preventative measure. Speaking of the Great Depression, I mean, people didn't seem to understand how the banking system worked. Even when people were working and were saving money and wanted to invest in, the Roaring 20s weren't called the Roaring 20s for nothing. But what happened in 1929, not just in the stock market, what I find interesting about 1929 is that people didn't understand how the banks worked. You had lines of people standing outside of a bank trying to withdraw money that wasn't there. They didn't understand that we have a reserve banking system. In other words, there wasn't enough cash in the bank.
Yeah.
The Federal Reserve System learned a lot. And today I think they, Bernanke and Diamond won the Nobel Prize for economics today, and that was their research. And it's about learning from, the things that the Federal Reserve did that exacerbated the financial crisis aspect of the Great Depression. And in some ways, 2008, again, like trying to dig
we
yourself
never
out.
learned.
No, I would say, trying to dig yourself, and in some ways the housing price, the collapse in the housing price in 2008 is comparable to the collapse of housing prices during the Great Depression. It's of a similar magnitude. But we did not see the kind of decline in the labor market employment. And so this is how you're gonna, so I think in some ways you can say, well, we still had 10% unemployment in 2009, 2010, but the alternative is that during the Great Depression we had 25% unemployment.
Yeah,
and that's how you compare. That's your benchmark.
Yeah, I mean that period of time with the Spanish flu, World War I. I mean, you had so many variables destroying you. And
that was earlier, but I mean, Yang's
10 years earlier.
You get all these things, the dynamics, and here's one of the things that I just find so fascinating. I think one of the reasons that the economy holds our attention, right? Partly what Yang and I both touched on is you can't understand completely today without understanding somehow we got here, right? Like, it's almost like a therapist. So Johnny, tell me about your childhood, right? Like, and that'll explain some of who you are today. And there's some of that with economies, right? Which makes it fascinating. But the other thing, like, think about the variables at play right now. What's Putin going to do next? Oh my goodness, that could be a massive ripple effect in the total global economy, right? What's Xi going to do next? Is he going to finally loosen the economy and say, you know what, we're good enough on COVID and we're going to open back up again? That has a ripple effect throughout the economy, right? What's going to happen in the midterm elections? And then I mean, you know, it's not inconceivable given kind of how extreme some of the Trump GOP is, that you know, they'll say no to raising a debt ceiling. That would have a massive ripple effect, right?
We already saw that.
One of the issues, yeah, we've seen that, but one of the issues with the system, and I love what Yang said about, you know, brittle versus kind of resilient kind of thing. As the systems get more complex, you know, it's harder and harder to discern what's the butterfly's wings beating in the Brazilian rainforest that sets off a snowstorm in Michigan, and what's just 1,000 moths beating at the porch light, you know, that has no effect. Like, it's harder to know which of those two are going to play out. And the other thing that ends up happening with that is, if you're managing, like, one of the things with the Fed that's so fascinating, Fed doesn't control military stuff.
No.
We don't have anything equivalent to the Fed doing monetary policy for doing fiscal policy, changing taxation, changing spending. If Congress can get coordinated, they can, right? But there's no agency that just says we need a stimulus here or we need to lessen up. So there's all these variables that nobody has knob control for that can have a ripple effect, right? And so it holds our attention because we're talking about demographics, an aging population that saves more. What does that mean? We're talking about geopolitics. What does it mean for Russia to, you know, and any of those, and to me, it just makes it utterly fascinating, but it's also really humbling because, you know, you're going, well, we could get smacked from behind, you know, it's Yang going down the, you know, ice with a hockey puck coming from nowhere, right? Like, you know, you can get hit by stuff that you just aren't looking at. So,
well,
anyway.
and that, well, even if you were prepared for everything, you're still not prepared for everything. It's the weirdest thing. You know, I just tell that to everyone. I'm like, I'm prepared for everything. I'm like, wait, it wasn't for that. But I think that's a good point. And I think I think we need to step back because I kind of jumped over what I wanted to do here. And we're talking about the Fed again and not really explaining. We talked about reserve banking. I think we should explain a little bit of what it is, so that people can understand. Like, what and Yang earlier when I said that we never learned, I didn't mean the system or the monetary side of things. I meant the normal people. People think when I go and deposit $10,000 in cash at the bank, it's sitting in a safe somewhere. And I'm like, that's not how the system works, you know, and that some of the money is saved in there because they've calculated using, you know, analysis of how much money people are withdrawing on a daily average basis. And they have like you said, in 2008, they put in new stress tests and stuff of that nature. But the rest of the money, the reason you get an interest rate on your savings account is because the bank is lending out your money. Okay, so that means if I lend out your money to someone else, that money is tied up. So when you come back and ask for it, if I don't have any reserves or my reserves have already been pulled out by everyone else trying to pull their money out, which we call a run on the bank.
Yeah, and that was the Nobel Prize in a way. It's was given out on this problem with banks in that if you need returns, to your point, you have to put the money to work. But if you want it to be safe, you have to literally put it, you know, in a vault somewhere waiting, right? And there's always the tension between those two. And that kind of you know, the way economies and financial markets particularly tend to work, they tend to swing, right?
Yeah, and
they tend to go from one extreme to another. So,
and I think this is a perfect segue into like, because then most people will say, oh, well, you see, this is all the bank's fault and those greedy guys from, you know, using our money and tying it up for so long, which leads us into the GSEs. And I'm like, well, I like to remind you that who owns the mortgage that you have is not the bank. They originated the loan, but it's very unlikely that they kept it on their portfolio. Some do. There are some portfolio loans, but the vast majority of them get sold in the capital markets as bonds and mortgage-backed securities that were created by these entities called the GSEs. You know, most people have heard of Fannie Mae and Freddie Mac, but they really don't understand who they are or what they do. So I actually created a video last year for one of my classes And I thought this was a pretty good, this is just a frame of the video that I thought was a pretty good high level. And again, guys, we are oversimplifying all of this because there's 1,000 ways to slice these things.
You have to.
Yeah, exactly. So because most people don't understand how MBSs and bonds and all that, like, why do I care? What does this make sense? So I tell everyone, I'm gonna look. When they make a loan, when a bank makes a loan, they then sell that loan to the GSE, Fannie Mae or Freddie Mac. Okay, so that's how they get their money back so they can go out and do more loans. Well, where does Fannie and Freddie get all this money from? Well, they take all those loans they bought, they bundle them together into these things called a mortgage-backed security. That brown thing is supposed to be a box. But yeah, so I basically dump all these loans into a box, and then they sell off slices of that box as mortgage bonds on the open market. So, well, who buys these bonds? Anyone, everyone. Government, you buy it on Vanguard in your ETFs. You can IRAs, 401ks. I like to think that when I had my mortgage, whenever I made a payment, I was paying myself in my 401k because my 401k may have had a bond tied to my mortgage. Okay, so the entire world is what's funding the system. So when we say that we're trying to protect the investors, we make it sound like it's the banks and these big hedge funds and yeah, they're taking their slices and this and that, but it's the everyday mom and pop. You want to retire your pension, your 401k, you're the investor. We need to protect you to have your money when you retire. So again, I created this kind of little slide, and I think I have another one in here that shows you who the investors actually are. So they go, go ahead, Marie.
So I want to kind of make a side point. I mean, kind of the point about this is that if you take the more macro view, right? So if you think about the extent to which, for example, right now, Russia is completely cut off from the international capital market. And what this means is that they can't, they are short-term liquidity constrained. They can't borrow against their future incomes to create things. And now there's, what that means is that they can't build things in a hurry, even if it makes sense to. And this kind of, the GSE in this case works as a conduit that funnels money from around the world into the American housing market. Now, you can argue that maybe that's not the best thing, but what this also means is that you match up capital to a very large segment of the U.S. market, and this drives economic development.
Well, yeah, but on top of that, I think one of the things that we're missing out to is the other main function of the GSEs is that they are the ones that make sure that the underwriting conditions, the risk analysis, they're making sure these banks, because they're the ones buying these things, aren't repeating the mistakes of 2006 and 7, although we can get into that too. That's a whole different podcast.
Create a whole new generation of mistakes.
Yeah, well, that's what I think it's funny, right? I was gonna say, I'm like, we are so smart that no matter what regulation we put in place, we come up with ingenious ways to get around it. And then new regulation has to come in place. And then sometimes we overstep with regulation and we have to roll it back. And it's a balancing act. It's not an exact science. And I think people need to realize that the Fed doesn't have this magic wand that this variable, if I put it in, will keep everything level. It really is a turn the knob, wait and see, turn the knob, wait and see. And sometimes you've gone too far and I'm like, oh, overreaction, let me roll that back. And it's not even easy to roll it back, and you got these in this world with the advent of Twitter and social media, you've given politicians this fodder to spill out to their constituents and demonize these people for trying to maintain a system and saying, oh, you see, the feds are trying to take away your money and your jobs. And because it so happens that Democrats are in power, it's their fault. And I'm like, well, the Fed is actually independent technically from the government in the sense that, yes, they're assigned by the president, but they make their decisions, they separate, supposedly independent from the executive and the legislative branch. Now they report to the legislative branch, but
we can look at places like Turkey, where the central bank is effectively tied to the executive branch, and it's a country with one of the highest inflation rates precisely because when the economy goes down, there is oh my God, we don't want to hike the rate to cause people to lose job. And what that means is that you have this continuously reverse ratcheting. And again, it's a high wire act. Yeah, it sucks. It's, if you're a realtor, it sucks right now. If you're, you're not, it's hard. It's much harder to sell a house when people can't borrow money. And I totally get that. It's, and it'd be kind of glib to say, hey, yeah, suck it up. It's that would be kind of unfair. But again, from a macro perspective, not having that ability to kind of increase rates to match inflation has a very high economic impact as well. I mean, 20-30% inflation in Turkey is absolutely having a long-term impact at their economy.
Yeah, and we've seen what inflation can do to countries. We've seen it in Central America. For crying out loud, look, I would argue that inflation was one of the major catalysts of World War II and allowing Hitler to get in power, because the Treaty of Versailles. I mean, people were carrying around wheelbarrows of freaking Deutschmarks to buy.
We're not even talking about hyperinflation. We're just talking about, again,
normal inflation.
Normal, I don't know if normal is the right word, but
Well,
15% inflation absolutely eats away. This isn't this 15% inflation is not going to cause people to go, have money on wheelbarrows and be complete, but it absolutely wears down your wealth accumulation. And all these things all have long-term. So yeah, no, I think these things are, these things all have long-term impact.
Let's try putting that
And
into
the one thing
practical.
too, when it gets higher, so if you're at 2% unemployment or 2% inflation, and if it jumps around 20% either direction, you're talking about 0.4 either way. So 1.6 to 2.4. If you're, to Yang's example, if you're at 20% inflation and it jumps around that same portion, right? Now we're talking about swings of like 8% from one year to another potentially. And the, one of the things you're trying to do, the world is full of uncertainty. And the extent to which you can minimize the uncertainty for things like, well, what will be inflation? What will real rates be? You encourage a more sane and a more steady kind of feeding into the economy of investments. And so, the price that we're paying right now is to get it back to a smaller amount, partly just because that works, and partly because now when you get the normal percentage swing around, it's not big. It's not a big deal. It won't change your business proposition for, is this a good or a bad investment? And so when you do that, you do encourage this long-term kind of prosperity, right? So that's part of the price we're paying. And yeah, to Yang's point, I mean, right now it's just bad for housing, but it's worth keeping an eye, because there will be a time where, boom, you want to move in on that, right? When you see things start to stabilize and shift. So
yeah, so two things. So one of them, I'm going to try to put it into practical words what inflation means, because I still don't think a lot of people understand the effects of what inflation is. So let's take your example, and correct me if I'm wrong, guys, because I'm trying to oversimplify this so that most people can kind of grasp it. So if inflation is at 15%, but you're like, oh, well, I just got a 10% raise this or last year, so what do I care? I'm making more money. In essence, your effective purchasing power actually decreased. So even though you got a 10% raise, if inflation went to 15, you're actually not able to buy as much as you were able to at your previous salary when inflation was lower. Is that a correct way to interpret inflation?
yes.
No, that was much simpler than I thought it was going to be. Sadly, I think people seem to, because I think people like, I don't understand why they're raising rates so high, and I'm like, well, inflation's at 9%. They go, yeah, well, so what? And I'm like, you don't seem to understand. And that's the other thing too, right? Most people live in a bubble, and here in Orange County, yes, a 10% increase is a lot, but enough of us have enough disposable income to absorb a lot of that. But in the South and the Midwest, that 10% is devastating. It literally, and it is, I can't buy enough food for my kids. I have to go on government assistance programs. So I think it's funny how all these people who are against, government programs and whatnot are like, yeah, screw them. Everyone should be able to pull themselves up by their own bootstraps.
I'll take an even more concrete example. All the houses that got destroyed in Florida.
Mm-hmm.
They need parts, they need supply, and this the massive run up in demand and prices have absolutely extended. Now you need, your time to acquisition for things like bathtubs went from what, well, a few weeks to what, months,
Mhm.
half a year. And we're at the point where there's some people where needing a new bathtub or needing a window isn't a housing upgrade. It's replacing something that you currently don't have because of, full on property destruction as a result of a natural disaster.
Well, on top of that, all those people whose homes were lost, I thought I was thinking about this the other day. Where did they go? What kind of, I mean, you don't get your insurance payout overnight. So however much cash you had in your savings account or on you, even if you go to a hotel, and right now hotel prices are through the roof, everything's through the roof. And you're probably paying more in hotel fees than you were on your mortgage. So not only are you homeless, probably not working, you're burning through whatever cash you have, waiting for the insurance companies, which are now inundated with claims. It's a very, very, very complex problem that I think too many people kind
This
of dismiss.
Well, this goes back to kind of the brittleness, right? Because we live in a world where everything is much more interdependent. And now, maybe maybe the people, again, 100 years ago, you have, or 1,000 years ago, you have a natural disaster. You wipe out entire villages. They're homeless. They're hungry, and it's awful for them. But from an economic perspective, there's no supply chain dependency. Now you knock out a bunch of people. It doesn't matter where you knock out a bunch of people living in Florida. Well, they make the parts that may contribute to the logistics supply chain for computers, and so that gets disrupted. And what that means is that cars can't be made, which means a whole bunch of people aren't getting paid to make cars, and so on and so on and so forth. And this increased level of interdependence goes back to, we need a financial institution. We have things like the Federal Reserve to reduce the level of uncertainty. And it's
And to
all
react to the
well,
uncertainty.
but it's the larger picture I can think of is that the whole idea of this kind of institutional evolution is to create a world that minimizes these kind of uncertainties, so that you have this international, have this very, very complex logistic chain to kind of function the way you want it to function.
And
Go
to
ahead.
Yang's point earlier, try to have some redundancy in the system. It's not optimal for lowering costs and increasing profit. In a short term, it's not optimal, but longer term it is, because you can shift from one thing to another as the inevitable disruptions hit.
Right. But if you think, but I think, and so yes, you have to have, definitely agree with Ron that you want to have redundant system, and I would make the argument that, well, the Federal Reserve. You think about the Federal Reserve, it's kind of costly. You need to hire a lot of economists, and they don't come cheap. And you need to have this whole system, and you have to have regional banks. You have to hire a lot of people, and they're expensive, but they're part of this redundant safety system.
Well, they have all the committees part of the Federal Reserve that.
But this is whole part of, I would classify that as part of the fail-safe system to make sure that you have an ongoing functional logistics system.
Well, speaking of fail-safe, and this is actually a perfect merging of the Fed and the GSEs for 2008. Let's talk about quantitative easing and how everyone was pissed off about printing money. I'm like, do you not understand that people, I guess I keep saying that, like everyone knows what we know, but one of the most catastrophic effects of 2008 was, yes, the massive foreclosures and people losing their houses, but the other massive problem was the massive credit crunch. Okay, you couldn't borrow money if you tried. The banks just seized up. They wouldn't lend anything out, especially and then they over qualified borrowers for home loans, right? You went from stated income, no job, no assets, no problem, to I need to see 3 or 2 years of tax returns, just insane criteria. And also the demand diminished or completely disappeared on the capital market side, because who's going to invest in mortgages after you just saw the collapse of 2008? So you get the Fed coming in with quantitative, and again, this is my understanding of it. Please jump in if I say anything wrong here. They go out and they start buying up these mortgage-backed securities, billions of dollars of them. Why? It created a demand. So now the banks are like, oh, I can make money by creating more of these mortgages. So let me start lending money out to these people. That triggered the credit market to unfreeze up and get the system going again. So again, that was never part of their original arsenal. I believe, from correct me if I'm wrong, Yang and Ron, the quantitative easing plan was something that they just came up with, but to get us out of the rut because we were on the verge of insolvency.
And that goes back to what you started out with, Johnny. My mandate is to keep inflation low and unemployment low. And the default and the almost cliche thing we talk about that, because it's such a big defining part of it, is tweak overnight rates. And through that, you'll change interest rates. But to your point, you know, the Fed's looking at this 2008-9, like this could have been massive. It could have been another Great Depression. There's reports that both the Treasury Secretary and the Fed chair at different occasions and meetings interrupted the meeting to go puke in a wastebasket. Like, you know, it was
There's
that
a great
visceral
movie on
reaction.
HBO called Too Big to Fail, based off the book, that actually shows that.
Oh,
They
is
showed
that right?
Paulson getting on his knees, begging Nancy Pelosi to get back in the room because John McCain came in and disrupted all the talks.
Yeah. So anyway, so then the question is, what do you do, right? And the beauty of a mandate is you really, in a way, what you're saying is whatever you need to do.
Yeah,
is what you're going to do. And to Yang's point, you know, 10% unemployment was so painful. And one of the things that made them more painful is it took so many years to get that back to something low. But 10% was not 25%, right? We did avoid the very worst of it. And, you know, we have a system, an economic system that has its moments of fragility and vulnerability. And so, you know, what the Fed's trying to do right now to help people feel better, there is a chance, a tiny chance, that unemployment rates never go up that much. What will happen is the number of job openings will go down and they're able to get the inflation down. And again, I know last time it raised a chuckle and I was being sincere. I still think there's some argument for transitory inflation, that just these different dynamics of things that are going on, that we could see inflation come down over the next couple of quarters at a pretty good clip. But that said, you know, long term, over the next decade, you want a stable system with low inflation. And if that means short term, to go right back to where you started, Johnny, if short term where government's laying people off, so to speak, because it's creating unemployment, you could do a cost benefit on that and say, you know what, that actually will work to the benefit of people in the economy and the economy over the next decade, even if it doesn't look that way for a couple of quarters.
Yeah, because to the point of the mandate that the Fed has, I think analysis has been done and they found that that optimum level is 2% inflation and 3% unemployment. Is that about right? Is that their target for the most part?
That would probably make everybody and their dog happy, right? I mean,
would love to do that.
3.5%, we haven't gotten lower than that, which we are right this month.
Yeah.
Our unemployment, it was as low as this just before the pandemic. It was low as this 2 months ago, and it wasn't lower since 1969. So this is low stuff.
So this is one of the things is, again, this is a good example of benchmarks. You know, we have to kind of think about these benchmark numbers in its own historical context. So right now, I think unemployment rate in Russia is 3.5%. If you look at that, it's like, well, yeah, everything's doing great. But in this case, well, Russia has 3.5%. You know, everybody who can, you know, you have this mass exodus of people of working age. And so this 3.5, it is a great mark. It is great, but it's also this 3.5 probably has a fairly large price pressure, because, you know, think about all the people who took early retirement, all the baby boomers who took early retirement. Think about all the excess deaths that we have, and so that's gonna, and so this 3.4, 3.5, whatever the unemployment rate is going to be a little bit different context than a comparable 3.5% that we saw in February 2020.
the labor force participation rate still
Yeah,
still
and
down a
so
little bit.
I was gonna say,
yes.
which unemployment rate is this? Because I know there's like a
Right, but
U6,
that's
U7 and all
no,
that,
well,
right?
but it doesn't matter. This is the same. So before the pandemic, I think the unemployment was 3.5, right? And now
Yep.
we actually have, in terms of absolute employment, we're back to work. I think we made it back, but this is also a world where, a lot of baby boomers took early retirement, and I can make fun of I'll make fun of baby boomer from
Go ahead,
time to
make fun
time.
of us. Go ahead, yeah, go.
I was gonna say that. Does that
But
mean, Ron?
there's probably some level of expertise that left with the labor force when they took early retirements. And yeah, you can promote the next person up, but it's going to take a while for them to have the same kind of productivity that some of these people left. And this doesn't even talk about, this doesn't even, we're not even thinking about, like the rural doctor who died from COVID in 2021. How do you replace that person's labor productivity? And so yeah, we have 3.5% employment. Yeah, we have a lot of job openings, and we have trouble filling up. And this is a world where the same numbers aren't exactly the same numbers because of all these different contexts, and that's very, very difficult to kind of all parse out and compare these numbers on an apples to apples basis.
So that's the t-shirt from this, Johnny. Yang's money quote is, the same numbers aren't the same numbers, given the change in context, which is kind of perfect, right? Like that,
I like that, and then we're gonna call it the YOLO index.
but I think, and again, these are really, really difficult moving targets, because we have nothing to measure against. Like, when was the last time we had the exact comparable situation? So you can say, well, okay, this 3.5 is really kind of this, and again, and that makes all these policies very, very, very difficult.
But we're three guys that have been dealing with this industry for a long time, and it's still complex for us. That's why I think it's so important to have these conversations and trying to explain it so that people who don't geek out on this can try to. Oh no, I can tell you right now, Ron. I
Well,
remember
the geeks are only, that's all that's left this far into the conversation.
Yeah,
Well,
probably. Yeah, if you're still in this conversation, I'm like, yeah, we kind of
gotta
really went
measure
down the
geek.
rabbit hole here.
If you think about in the last 5 years, everybody, if you think about the experience of America last 5 years, everybody is now a self-professed public health expert.
Well,
and legal expert and criminal
and
law
finance,
expert
Robin
and
Hood and Tech Guru
and so but I like to think that economics, because it impacts everyone's life, even before, even during quote unquote normal times, people do have some innate, have a fair amount of innate interest in the economy and economics. And so we can talk about we can get into the technical weeds and all that stuff, but at least as a topic, people aren't people in normal times aren't talking about R0, R1 in terms of kind of public health pandemic transmission rate, but in normal times still talk about the economy.
Yeah, not everyone subscribes to
yeah.
your Facebook feed, Yang.
Educational, very much.
Actually, that's how me and Ron met.
And at that point, really, what we're trying to work toward in these conversations, I think is an acknowledgement of the necessity. We have specialization.
Yeah.
But in a democracy, it's necessary to somehow get to a point in the conversation where people could choose between candidate A and B, policy A and B, with some degree of confidence. And that means you got to learn some things that, about what defines your world. Yeah. And so, a nod to you, Johnny, for trying to, get this conversation going. And it is incremental, and, for people to get this. For me, the punchline, and probably, good to start looking at a wrap on this. For me, the punchline is a massive amount of uncertainty. That will, in my opinion, mean some good opportunities for people keeping an eye on things over the next few months. There may well be an opportunity, like I think one sweet spot that could well happen here over the next 2 to 10 months kind of thing is home prices will fall. So everybody who's trying to buy is happy for that. And then mortgage rates will be too high for a bit, but then those mortgage rates will start to come down too as they re-engineer kind of a recovery. And there will be a window there where people who even 6 months ago were going, Johnny, I want to talk to you about a loan, but it's impossible. I can't afford anything. They're going to have their moment. There's going to be this time where the mortgage rates and the home prices both will have come down some, and there'll be an opportunity for people to come back in some.
I agree.
So,
Absolutely agree.
Yeah, absolutely. All right, guys. Well, I appreciate your time. To sum up, guys, the Federal Reserve is not trying to get you fired. They have a very, very, very hard.
But they're not
job
against that philosophically.
Yeah. I mean, not directly anyway. Unintended consequences.
Yeah.
It's a very complex topic, guys. I thank you guys so much for the input. I hope this brought some sort of clarity, if anything, to some of you guys. And again, appreciate you guys and look forward to our next one, because I really do love talking to you guys about this stuff. So
it's
thank
a
you so
fun
much.
conversation. Yeah, thank you.
All right,
thanks,
guys.
John.
Thank you so much.
All right.
You guys have a good one.
Take care.
Okay.
Bye.
Well, guys, thank you so much for listening in this week to the Real Geek podcast. We hope you enjoyed it. If you did, please hit that like button and subscribe so you can stay up to date on any new episodes. This is Johnny Garcia in the Real Geek podcast studio saying it's just math and science. Once again, thank you for listening, and we'll see you next time.